Let me share my screen. Okay. Well, the first question, which of the below is not a function of financial markets? Borrowing and lending, price determination, issuing credit and debit cards. Again, borrowing and lending.
C.
Yes, that's right. So issuing credit and debit cards is something, is not the function of the financial markets. Actually, it's a function of the credit card companies. Okay, next one. Which of the following is the largest and the oldest bank in India, which is and still in existence?
SBI.
SBI, yeah, right. Yeah, correct. So in the banking world, SBI is called as DAD for especially the forex world. So what they do is that like dad says and then the kids follow, right? The same way in the morning, everybody waits for what is the quote SBI is going to give. So is that like USD to INR is going to be 77.5 or 77.435. So what is that SBI is going to give? So based on that, others people starts adding some more adding some better price than that and then start quoting in the market. So SBI is something called as DAD for the forex market quotes. And even SBI employees also have some better facilities and treatments as compared to other nationalized banks. So Rachna must be knowing more. So then the next one, in primary markets, first time issued shares to be publicly traded in stock markets is considered as effectively, the first time issued shared are called as, what is that?
Public markets, I guess so. Public markets.
First time issued shares to be publicly traded in stock
Initial
markets.
public
Offering, yes,
Initial
that's
public
right.
offering.
Initial public offering. That is the place where the shares are issued for the first time, and then after that, the shares are put it in the secondary market for the trading. Now LIC IPO is coming, so which is going to be a hot IPO. Hot listing IPO means whatever the price that is offered is going to be at least 50% or 100% growth. You could see it, or at least 20%. I would say 20% growth. You could see it just by the time it gets listed in the stock market itself. Now I think, say for example, SBI, if LIC IPO comes with share price of say 500 rupees, and then within 10-15 days it goes for the listing, and there itself you could see that the share price has gone to 600 rupees or more. So that is the way it happens. So those are called as hot listing IPOs. So there are scenarios where once it goes into the secondary market, the price might have fallen down also. There are scenarios like that also. But overall, if you see, many IPOs make good success, at least for the first few days, once they get into the secondary market. So that's why there are some mutual funds offers only for IPOs. Okay, so whenever IPO comes, they say that only for a hot list IPOs, they go ahead and they invest it, and they wait for 10-15 days. Once it listed in the market, they see the trend, 1 or 2 days they see, and then they immediately sell it. So within these 20 days, they can make a profit of 15% or 20%, which is a decent, not decent, which is a very good amount as a return to showcase to the customers. Okay. Stocks are shares that are sold to investors without transacting through financial institutions are classified as.
Ramesh, we don't see your screen, like we're not able to see it.
All right, okay. Okay, so we are discussing the fourth question. Stocks are shares, okay, that are sold to investors without transacting through financial institutions are classified as. So effectively, see, whenever I sell the shares, now, okay, I'll have a Demat account. I will have, so through the Demat account, when my Demat account is like a savings account, the way savings account is there for money, Demat account is there for shares. So if I buy some shares, the shares get added to my Demat account. If I sell shares, my shares will go out from my Demat account and goes to the person who bought the shares, and the funds get credited to my savings account. So this is the way the transactions happens. So generally what happens is that I or anyone buy or sell shares through NSE or BSE platform that are provided by financial institutions. But there are some possibilities where I can just have a direct agreement with say someone, and say probably say Nancy. Okay, say Nancy, I'm going to sell you 10 HDFC shares, so you transfer me the funds. I can also do that way. So then what will happen? I don't need to involve the stock exchange. I don't need to pay the transfer cost or the related taxes for that. So I can just sell it to Nancy, and so Nancy will transfer the funds to me, and I will transfer the shares to Nancy's Demat account. So this is called as direct transfer. So in the direct transfer, so effectively stocks or shares, okay, are directly transferred from one investor account to the other investor account. The next one is depository institutions such as thrifts include savings associations, loan associations, credit unions, all of the above is the answer. What was this? Yeah.
I don't think loan, all of the above might be. Loan associations, I don't know, I'm not sure about that.
So effectively these are
what is loan associations?
They mean to say that it's a group of customers, together formed as an association, and they offer the loans to the customers like a non-banking finance company.
You mean like two or three banks, like they'll join together, or like
It's like a non-banking finance company where the funds are there with the NBFC, and they give it as loans, like Bajaj Finance Company. If you see that, okay, so Bajaj Group has funds, so they transfer the funds to Bajaj Finance Company, through which the loans are issued to the customers.
got it.
What was the State Bank of India called before it was created through SBI Act?
Imperial Bank of India, I guess.
Yes, Imperial Bank of India. When was the Reserve Bank of India established? It was established in 1935. So April 1st, 1935. So the first Bank of India, Bank of Hindustan, was established in the year. So when was Bank of Hindustan established? Effectively,
1947.
Which one?
I'm thinking 1947. I don't know.
19. No, 19 before that itself.
1880, 1880 maybe. Yeah.
No, even before.
Oh, then definitely 1770.
Wow, that's long time before.
Yeah, yeah, right. 1770. So if you see,
Yeah.
right, so this effectively means that banking is as old as 300 years or 500 years old. So the first bank was established in 1770. So before that also you can see mortgage lendings, credit lendings were always there. So so banking is not something a new concept. It was like very old, uh, 300 500 years old concept. And day by day, slowly it is improving, maturing, and we are taking the adoptions, are driving the adoptions, which is an apex institution to provide facility to agriculture. So the keywords here are agriculture and then apex institution.
NABARD.
NABARD, yes. National Bank for Agriculture and Rural Development. Which of the following service is a fee based? So now we are asking not fund based. Okay, so all the I think one of you might have missed the session that day. So all the bank services can be divided into two types. One is fund based and the other one is fee based. If bank is giving its money, then it's fund based service, fund based product. And if bank is not giving money, its money, just working as just a pass through kind of uh, agent, then it is called as a fee based service where it just receives the fee for the service it has done. Okay, so let us see which could be the option. Yes, issue of demand draft. Okay, so let us see the other ones. Education loan. So in here, the bank is giving its money, and then after that, it is taking that credit risk, and after that, it is collecting the EMI from the students who has taken the education loan. So that is the one. Overdraft. Here also, bank is giving funds to the customers. And then short-term finance. So here also funds are involved. So effectively, if you look at issue of demand draft, here bank is not giving its money. So bank is collecting the funds from the customer and then giving the demand draft. And whenever it comes for the realization, it is paying back the money to the customer. Okay. Which of the following services is a fund-based service? So here it is asking which is a fund-based service. Loans.
PNB.
Loans is a fund-based service. Yes, overdraft is a fund-based service. And how about fund transfers, issuing checks?
No, they
These two
are
are
like,
not fund-based. Yes,
yeah.
fee-based services. So bank gets money by doing this activity as a service. Okay, this is a good one. Bank does not give loan against which of the following? Gold ornaments, LIC policy, lottery ticket, NSC.
NSC,
So,
yes.
sorry,
NSC.
Lottery ticket.
NSC.
Lottery ticket or NSC, maybe either of this. Lottery ticket or NSC.
I don't
Okay,
think so. There is not.
Yeah, fine. I'll explain you what is NSC. NSC is National Savings Certificate. It's like a term deposit given put in the post office.
So then
So
lottery ticket is the one. Yeah,
yes,
I think.
definitely yes. Lottery ticket, yes. So there are some areas where even the central bank says that banks should not give loans. So like one is the lottery ticket and second one is film financing. So that is the area. If you see any movie, right, either it can make 100%, 200% return, or it can fall short of even 20%, 30% return also, or even get into loss of 50% of the invested money. So high risk is involved in film financing. So that is the kind of area. So like that, there are some areas where the RBI says that banks should not give loans. So lottery ticket, even suppose even if the bank choose bank bank is pretty much sure that, you know, the who is going to buy the lottery ticket is a highly lucky person and he can get the lottery, say, what is it, an euro lottery, right? Million euros or 10 million euros. So even so, those kind of scenarios also banks are not supposed to give loans. One is that it's a gamble, whether return will come or not. Second is that the central bank also prohibits them to give loans to this kind of things. Okay, a bank finances an agriculturalist to buy a tractor. Okay, the loan is secured by what? Okay, here we all know that. Okay, so the bank is giving the finance and the collateral is a tractor. The primary security is a tractor. Okay, so this we know that. But now what is the terminology we use for tractor loans? Okay, when it is when it became a, yes, when it became a security to the bank. Yes, hypothecation is the word we use for the tractors. And second one is mortgage. Mortgage is the word, terminology we use it for which loans?
Property.
Yes,
Loans
that's right.
and property.
That's right. Right. The word mortgage we use for houses and other properties because because actually, I mean, we are not able, I mean, you know, the bank are bank is not able to, cannot move the location of the property from that place to another place. If it is a hypothecation is the word we use it for the movable items like car, two-wheelers, tractors, buses, any kind of movable items, we use the word hypothecation. And the documentation also related to hypothecation documentation. And if it is a non-movable item, we use the word mortgage. And the next one is pledge. Pledge means this is something where the bank takes the ownership of the item for a shorter period of time. Bank takes the security, whatever the security that is there, and keep it with it. Which is the items we can say for pledge?
Gold.
Yes, gold, shares,
Okay.
bonds, all these things we use the word pledge. Okay, and the fourth terminology is assignment. So, for example, if it is say life insurance policy. Okay, so in case of life insurance policy, we use the terminology assignment of the insurance policy. So in this case, the bank is not owning the insurance policy, but whatever bank is keeping that insurance policy as a security. However, the insurance company has to state that, okay, whatever the return that has to come to the that has to be given to the customer would be assigned to the bank first. So only the remaining amount would be given to the actual holder of the insurance policy. So that is the way the assignment agreement will happen. So after that, the bank gives loan to the borrower against the insurance policy. So that's an example of the assignment. So these are the four different terminologies uh, you can keep in your mind. Hypothecation for the movable assets and mortgage for the non-immovable assets and pledge for the items where the bank can take the ownership and hold it with it. Assignment for the items where the receivables need to be assigned to the bank. Okay. So, okay. Okay. Now I will ask you one question. Suppose if a bank is giving shipping finance, the security is the ship. So then which is the agreement the bank should go for? Hypothecation agreement, mortgage agreement, pledge or assignment?
A.
Okay, any other answer? Okay, so this is a good point actually, bit tricky. So we had this doubt clarification when we were doing the shipping finance. So then we went to the our legal counsel, and then legal counsel reviewed a couple of judgments given by the courts. So then they realized that shipping finance, the ships would come under the category of the mortgage. Why? Because you cannot move the ship out of the sea, out of the water. So effectively you can move it, but you can move it only till certain extent. You cannot take the ship and put it near your branch, right? So that's the reason. So they call it as a mortgage contract. So for ships it becomes a mortgage.
But it can sink and go inside, right?
Yeah, 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 right, right. Mm. Yeah, in that case, probably house also can.
Exactly.
uh, okay, the next one is PIN in your ATM card is what does
B.
PIN stands for?
B, the personal identification number. B.
Yeah, personal identification number.
That was the most easiest question, I guess.
uh, which one pulls money from investors and invests in stocks, bonds, shares? So they collect money from the investors and they invest the money in stocks, bonds, and shares. And based on the returns they get on these ones, they will give back to the give back to the investors. So the returns are based on the returns that they receive from the stocks, bonds, or shares.
B.
Yeah, D, mutual fund. Mutual fund is the one
Oh.
that pulls money. So did you say?
I don't know. I thought it's a broker. It's a banker, merchant banker. Sorry, the B.
Okay. You said B, is it? Okay.
Uh,
Okay. Okay. Yeah, I will tell you. I'll tell you what is merchant banker and what is the mutual. Okay. So mutual fund is a place, it collects money from different investors, and this money is invested in different stocks, bonds, and shares. So effectively, if you see here, it pools the money. Okay. And whenever you look at the mutual fund portfolio, you can also see that how much percentage they are investing in what sector and like that. And they also mention what is the entire portfolio they are maintaining. Maybe if you look at any fund like ICICI tax advantage fund, or Axis Bank Capital Growth Fund, any fund if you see, they mention they are maintaining a pool of money, a portfolio of money of 20,000 crores, 10,000 crores. So that is why they mention the pool also. So they collect the funds from all the people and they make it as a big pool. And from there, they start thinking, okay, where to invest this money. And so after that, once the returns comes, then the returns are also equally distributed to, pro rata distributed to all the investors. So that is the way it happens. And suppose I invested 20,000 and say Varsha, you invested 40,000. And after that, if you go back and ask them, where this 20,000 or 40,000 exactly gone, they don't have answer, because they just collected all the money and then started investing it in different profitable investments. Okay, and then merchant banker is the one. It's an investment bank effectively. So it conducts various activities. One is if a new company is coming up and if it wants some funding, so it will help the company to raise the funds through initial public offering, and also it also provides demat services. So or otherwise, suppose if somebody wants to say for example, they do some private banking facilities like suppose say you have say for some example, you have some 50 lakhs and you don't know where to invest. If you give to the merchant banker, they will assign one portfolio manager for that, and that manager will look at different options that includes mutual funds or direct investments in shares, bonds. Okay, so they look at the different options and they invest it, and so based on the returns they get. So effectively what merchant banker offers is a dedicated portfolio manager who who does the investments for you. So they help both investors who wants to invest, and also they also help the companies, corporates to raise funds. Okay, so the next one is credit risk is. What
I
is
guess
credit?
default of the customer to repay the loan.
Yes, yes. Credit risk from the bank perspective is default of the customer to repay the loan. The credit risk from an individual perspective is that, say, my perspective, what is credit risk? Probably I opened I opened a savings account with XYZ cooperative bank. So, there is a possibility that XYZ cooperative bank may default. So then I may lose whatever the money that I kept it in the cooperative bank. So credit risk for me is uh, the bank's failure. Credit risk for the bank is that whatever the loans it has given to the customers, and if customers doesn't repay, then it's a default to the default of the funds, and then the bank will lose the money. Okay, what is it? Okay, maybe we'll come here. Payments we'll do, and then we'll come here. Till this fine, any questions? Okay, so now we'll go back to the last class we discussed about the overall flow of the loan sanctioning, maintenance, and closure, overall loan process. So now we will talk about different types of the loans. So especially we'll talk about the retail loans. You might be knowing all these things. Maybe wherever you need more information, you can stop me. Otherwise, we can go quickly in this area. Okay, so this is the flow chart we discussed in the last session. So what are the different retail banking lending products that are offered? Home loan, vehicle loan, personal loan, educational loan, consumer loan, loan against securities. Okay. So these are the main offerings by any retail banks. So, okay, if you see home loan, pretty much simple. This is the primary security is home. Okay, vehicle. So it could be a two-wheeler or four-wheeler vehicles, and the personal loan. So where there is no reason to be stated to the bank, so customers can apply for the loan for their any personal reasons, and educational loan for education purpose, and consumer loan for buying consumer goods like phrase, TV, or any electronic items, any consumer related equipment items, maybe furniture. So this loan can be availed and the loan can be taken. And then the next one is loan against securities, deposit shares. Say if you have some term deposits with the bank, or if you have some shares, you can give those items as the security to the bank and you can take loan. So that is loan against securities. Just 1 second, please. Okay, so there is a small terminology, home loan and housing loan. Two types of things are there. Generally, these two are used interchangeably, but there is a terminology difference. Home loan means home is something which people live. A family lives, that is called as home. House is something, an abandoned home is called as house. So generally people call it as home loan because actually, I mean, we are giving the loan for the people to live and, for the people to buy the house, buy the home and buy the house and make it as a home and live in that place and also repay the funds. So that's why we generally call it as home loans, but housing loan is also people use it. You can say that both are used interchangeably. Okay. Housing loans are referred to the loans provided by the banks for the following purposes. Okay, for the construction or purchase of the flat or house. It could be construction of the house, or it could be for the purchase of the house, or for the repairs or renovation purpose, or or resold property, or for the purchase of land. Purchase of land can be also, housing loan can be given for purchase of land also, but there is a criteria that within 1 or 2 years time they should do the construction. So generally the criteria for housing loans differs from bank to bank. Every bank has its own policy, and based on that policy, they give the loans to the customers. Okay, so if your bank is conservative, then it might be having some conservative policy or some strict policy. Whereas if a bank is aggressive, then probably the bank has some liberal policies. Like say, for example, the eligibility is mainly for individuals, salaried class, businessmen, professionals with minimum period of service. Say, for example, if a bank is conservative, then they may say that, okay, minimum 5 years of service is required for anyone to avail the housing loan. If the bank is liberal, probably they say that, okay, fine, they can give the loan for anyone with the minimum 1 year of service. Okay, and similarly individuals. Okay, so some bank might say that up to 65 years of the age they can give housing loans. Some banks might say that up to 55 only they can give loans. So like that. So each bank will have its own policy. Okay. Okay, so the loan amount will be calculated based on the value of the property the customer is going to buy, and also based on the earnings of the customer. So generally what happens is that, okay, say gross salary. Say someone's gross salary is say 100,000. And after the tax deduction, everything, tax deduction and any standard deductions in the salary, then the net salary is 70,000. Okay, so the house property, so that he's going to buy is say 50 lakhs. Okay, so so what is the eligibility amount? So this customer came to the bank and said that, sir, 1 lakh is my salary. Net salary is 70,000. He gave you a pay slip as a proof, and the house property he's going to buy is 50 lakhs. So if this is the case, how much loan can be given to this borrower?
Typically
Okay,
with a 20% margin.
okay. So duration also matters. Okay, yeah. So 20% margin, right? So 50 lakhs into, okay. Let me use the margin. You said 20%, right? Okay. So this also depends upon the banks and the bank's policy, which is guided by the central bank's policy. So 50 lakhs into. So this means that after 20% margin, that means 40 lakhs is the loan. The customer is eligible. Eligibility based on the collateral. Is this the only way they can decide, or anything else? So suppose if customer says that, if he says that he's taking a loan of, he's buying a property of say 5 crores. 50 crores. Okay, fine. So if the customer says that, oh no, okay, his salary is 1 lakh and net salary is 70,000. He says that he's buying a property of say 50 crores. So will you give 40 crores loan by keeping 20% margin rule?
No, it also depends on the income.
Right. So, okay. So how do you decide on the income?
Again, typically it is 5 or 6 times of their gross annual income, and you
Right.
also need to take their liabilities, all that into account.
Right. If it is a personal loan, then effectively it's like 3 times or 5 times of the salary. If it is a housing loan, since it's a secured one and long term in nature, so that's why we take it as, say 3 years of the gross salary, or 5 years of the net salary. So generally, higher of these two will take it. So 36 lakhs and 42 lakhs, which is the higher 42 lakhs, right? Max of. And then lower of this salary eligibility, and then the housing loan eligibility based on the collateral. So then we get the value. Okay. So here, if you see, he is buying for 5 crores, 5 crores or 50 crores of the house property, but still he is eligible only for the 42 lakhs loan. That is because the gross salary, the net salary is only 70,000. That is turned into 42 lakhs is the maximum limit that is coming to. And suppose if the house value is, it is most unlikely case. So if we Because if he is buying the house for 50 lakhs, then effectively if you see 80% of 50 lakhs is 40 lakhs, and then 42 lakhs is the eligibility based on the salary. So which are minimum of these two 40 lakhs. So this will become the loan eligibility. Okay, and when it comes to the interest rates, there are two options. One is fixed rate and other one is floating rate. Fixed rate means the interest rate may not change for the next 5 years. So there will be a minimum fixed rate period. So generally the assumption or perception that fixed rate means the entire tenure of the loan. If someone takes for 20 years or 30 years, entire 20 years or 30 years is a fixed rate. The interest rate will remain same, but in reality it is not the case. So in case of fixed rate, say around 5 years, the interest rate will be constant, and after 5 years the revision can take place. And in case of floating rate, the revision can take place whenever the bank's underlying interest rate changes. So there will be an underlying benchmark, say bank's prime lending rate or bank's retail prime lending rate, something like that. Some benchmark will be there. So based on that benchmark, say for example, bank's prime lending rate plus say 0.5%. If bank's prime lending rate is say now 8%. So as effectively the interest rate would be 8% plus 0.5, 8.5% will be the floating rate interest rate, floating rate. And what will happen is that, say for example, if bank's prime lending rate change it to 8% to 9%, then this loan will become 9% plus 0.5, 9.5%. So the rate change effectively happens immediately in case of floating rates. In case of fixed rates, it would wait for next 5 years, the same rate will continue. And then after that, the rate will change. And again, once the rate is changed, again that would continue for the next 5 years. Housing loan sanction, so the maximum tenure that can be 20 years. Even nowadays banks are giving even for 30 years also. So the only criteria is that the person's retirement age should not be beyond that. Repayment methods. So this is EMI. So the equated monthly installment. So the single installment amount will come for the installment amount will remain same for the whole repayment period. And this is a processing fee, 0.5% to 1% from the bank to bank. And what is the security? Mortgage of the house that is going to be purchased. Entire home loan management we can categorize into 5 parts. One is the origination, where the loan request comes to the bank, and then verification by the bank's executives, verification of the documents, verification of the physical location of the property, verification of the value of the property. So all these things would come, and then finally sanctioning of the loan. And then once this loan is sanctioned, disbursal of the loan, where the customer comes to the bank and sign the documents and also submit the original title deeds of the property. And then the disbursal happens through account transfer or through check. And then after that, maintenance of the loan will happen. The customer pays the installment on a regular monthly, on regular EMI basis. And then finally closure of the loan. Okay, so what is the eligibility criteria? At least 21 years of age, maximum age could be 65 years age, or the retirement age, retirement time, whichever is earlier, that is taken for the long period. Say for example, if someone is 40 years, then the maximum and the retirement age is 60. So then even if the customer applies for 30 years loan, the bank will not provide. The bank says that the retirement is 60, so effectively they can give the loan for 20 years only. And what documents are required? Residence, address proof and ID proof, and sale deed or agreement of sale, bank account statement, Form 16s, IT returns, repayment capacity. If it is a business, then they should showcase that how much is the turnover happening, and what is the income returns they submitted. House approved plan, current construction permission. So like this. Okay, so all these things are required. And final one is the closer one. So when it comes to the closer, there are 4 possible scenarios. One is that the loan tenure completed, the customer has repaid the loan as per the tenure, and then the loan gets closed, and the title documents of the property would be given back to the customers. That is a normal closure. The second one is the customer defaults payments, and bank therefore sells the property and closes the loan. That is called as foreclosure. Okay. So then the next one is the customer request for the pre-closure. Actually, here the terminology is pre-closure, where the customer got some funds and they want to close the loan before the loan duration. Okay, so that's called pre-closure. Similarly, suppose the customer got some extra funds, they can go and pay to the bank so that they can reduce the liability. That is called prepayment. Prepayment means you are just making some extra payments. Pre-closure means you are going ahead and closing the entire loan. And the fourth option is customer requests another bank to take over the existing housing loan. So generally it happens when one bank has given the loan at lower interest rate. After that, 2 years down the line, if the customer figured out that the rate what the bank has given is not so much relevant in the current market, so then he can apply to another bank and another bank take over the loan. So that is the fourth option. Any questions on housing loan? Okay.
No, Ramesh.
Oh, thanks. Okay, similarly, vehicle loan, if you see, so this is secured by the vehicle. So the eligibility is any government employees or any private sector establishments So similarly, you can see the terminology. Okay.
Excuse me, I can't see your screen, or is it just me?
I
How
think
about
so
others?
because yeah.
Okay. Should I? I think I'll leave and join again.
Okay, just a moment. Otherwise, I'll just try to reshare it. If at all you cannot see it again, then you can.
Yeah. Okay.
Please. Okay, Rachna, generally what happens is that when the network is lower bandwidth, right, that time also
Okay.
sometimes yeah, the screen doesn't appear. Are you able to see it now?
Yeah. Now I can see. Yeah. Thank you.
So, okay, when you see the vehicle loan, right? So the maximum loan amount is given is 2 times of the net annual income. Okay. So effectively, if you see for housing loan, how many times of the net income? It was the 5 years, right? 60 times of the net annual income. Sorry, five times of the net annual income. That means 60 months of the net salary can be given as a loan to the customer. Whereas here only 24 times of the net salary of an employee or of a business person can be given as the loan. Yeah, if married, okay, spouse income can also be considered even for the housing loan also, provided they are added as the co-borrowers or guarantors. Also, it also includes the one-time road tax payment also, registration and insurance, everything. So what is the margin? So generally, if you see all the new vehicles will have 10 to 15% of the margin. This is the amount the customer has to pay, and remaining amount can be taken as the loan. So how the repayment can be done? Maximum period is 7 years, and repayment can be done anytime before that. They can do pre-closure, or otherwise foreclosure can happen if the borrower is not repaying the loan. And you can see the interest rate of the vehicle loan, fixed rate and floating rate same. The hypothecation. So if you look at hypothecation, okay, so the original documents pertaining to the the vehicle will be with the bank until the loan amount is completely repaid by the customer. And why this is called as hypothecation? Because it involves a letter of hypothecation to enable the bank to sell goods, okay, that have been pledged to them as security for a loan. In case of these vehicle loans, a letter of hypothecation is involved. And then personal loan. So as the name says, it is for meeting any kind of personal expenses. It could be marriage, family functions, medical, educational, travel expenses. What is the eligibility for the personal loan? So generally 3 to 4 months of the salary, maximum 5 months of the salary is given as the personal loan for the customers. And the eligibility could be, minimum 2 years of service in a company and minimum qualification. Or so if they are doing business, then at least 2 years or 3 years of the financials should be available. Okay. And then the amount, so minimum amount should be given is 24,000, which is okay, 12 times of the net monthly income. Okay, salaried individuals and self-employed professionals, how much can be given? So what documents are required for a personal loan? Suppose if someone is asking you for a personal loan from your bank, what are the documents you look at?
So depends on like, what, first of all, we have to do the credit check, right? And then if they are already customer, then it's okay. Like, still we have to pull the credit. The requirement is every month we have to pull credit if we are doing any kind of lending. And then income confirmation. So depending on if they are self-employed, if they are employed, if they are like, part-time, and also we just follow whatever the policies for the bank, like, whatever requirement we need for the income verification. And then uh, like for the personal loan, if it is secured or it is not secured, that is the another thing. And then we see what kind of interest we are offering. And that's all I guess we do for the personal loan.
Yes, that's right. So one is something like the ID proof, address proof, and then the salary slips are income documents. And if they have some qualified, okay, so I don't think now the market is taking the qualification, certificate. So and then the address, okay, so address verification is something to be done. Most important thing is the credit check to be done through CIBIL or Equifax or any kind of third-party services to see that what is the credit score and what is the loyalty of the prospective borrower. So it is repayable in 48 installments maximum. I think up to 60 EMIs also it can go. Processing charge is 1%. And then the consumer loan. It's a very short, small amount loan. Maybe like 50,000, 1 lakh, 2 lakhs, which is for purchasing the consumer durables like TV, washing machine, phone, AC, furniture. So margin is 15%, and then what is the loan amount? It's also based on the monthly salary and the kind of consumer goods they're purchasing. Security is hypothecation of the same article or durables or equipment purchases. The repayment is EMIs through maximum of 660 EMIs. And the next one is loan against deposits. So if you have term deposits with the bank and then you want to take a loan. Okay, so if you go for a personal loan, definitely the interest rate would be higher, and you need to show your income proof and then consistency of your income. So all these things would come into picture. So instead of that, suppose if you have some term deposits, then you can give that term deposit as a security to the bank and take loan against that term deposit. So generally, whatever the term deposit interest rate is there, so 0.5% extra the bank takes and gives it as a loan. Say, for example, if the term deposit interest rate is 7% and you want a loan against the term deposit, so bank says that okay, you 0.5% more, so 7.5% of is the interest rate for the loan. And so in that way, if you see, the net loss is only 0.5%. So for term deposit, and you are taking loan against the term deposit where you are paying 7.5% interest. So the effective, that means that the net loss is only 0.5%. Whereas if you go with personal loan mode, then you may need to pay 11% or 12% interest rate. So that means that 5% more than your term deposit interest rate. So, and will they give the 100% value of the term deposit? No. So what they do is that what is the current value of the term deposit, including the interest that is accrued in the account. And then on that, they will give 85%, up to 90% they give as a loan amount against the term deposit. So on the maturity date, if the loan is not fully paid, then the bank will close the term deposit and then adjust the loan against the term deposit, and the remaining amount is paid to the customer. Then loan against securities. So security means that shares, debentures, bonds, okay, different kinds of financial instruments. So So these are also just to meant for meet unforeseen expenses. So I guess up maximum limit is 20 lakhs. That also depends on the bank to bank. So margin amount, if you see here, it is 50% margin. Why 50% margin? Because the security that is given is shares, bonds, and all these things, which are subject to fluctuations in the market. So that is the reason. So if somebody gives say 100,000 worth of shares, the bank gives a loan of only 50,000. Bank also looks at what are the shares they're giving it as part of this 100,000. And after the due diligence, it will offer 50,000 as the loan to the customer. And what kind of documents are required? Say some declaration saying that I'm taking this loan not to buy another set of shares. I'm taking this loan for my personal expenses. And the customer also need to give a declaration saying that mentioning what are the loans the customer has availed by showcasing this security. So generally this is not possible, but some declaration is given by the customer. And then whatever the shares the customer gives, those should be good liquid securities. Suppose if a customer comes and says that he or she will give some unknown company shares as a security and take the loan, then the bank doesn't accept, because if the customer doesn't repay the loan and if it goes back to the market to sell the shares, they may not find buyers for those shares. So that is the reason the bank always looks at the taking the security of the shares that are having good liquidity, are sellable in the market as early as possible. So only those kind of shares the bank takes as the security and offers the loan. Okay. Any questions here?
I think it's totally like it's a lot of different than what we do here. So it's like so confusing, but good to know, like, what happens.
Okay. Yeah, maybe you can tell me, okay, what you guys do. So then probably we'll try to find out what are things that are.
Yeah. So for example, you said like, against the term. So when we give any kind of like secure, like the cash secured loan, then we can go up to the 100% of the value of the term. And then like, when we do that, it's kind of like a line of credit. So it is always there for the member. And then we put the a term for maybe like 50 years. We hold it for 50 years. Like we put a date that it's going to expire in 50 years. We keep on renewing. Like if it is for 1 year, we renew it for 1 year, and like, keep on renewing. And if the member wants to pay it off, like, pay the line of credit, like the customer, then we just close that and we release the hold on that term. And we don't need any kind of documents like no income confirmation, anything. We just check whether that is a member, like to verify the ID and all, like for the customer. And then we can give up to the 100%. So like, there is no 85% or anything like that. And we can give them the loans just against like, a few terms, not like against their RSP or anything like the retirement fund or for the mutual fund or anything like that. It just has to be in the term, like in the GIC, like the fixed deposit.
Okay.
Yeah. So, and other loans too, like I'm looking at, yeah.
This loan is against what? Against the securities or against the fixed deposits?
Against the fixed deposit. We don't even give the loans against the security. Against the what do you say, even against the gold or anything, we don't do anything like that here.
Okay, so because actually, I mean, it's a credit union, right? So it might be having some strict policies.
Even in the banks too. I used to work for TD before, TD Canada Trust. Yeah, so they don't do like, against the what do you say, against the gold Yeah, we do the consumer loans, like it is called as fast forward loan, which we do it for like, maximum for a year or so, which would be like, that is correct. That is something like, similar to what in the India, but we don't do for like, TV or anything. It would be against like, I want to pay my credit card because the interest rate is too high. I'm paying 19%. So it will be like, okay, fine, you want to pay it, and maybe there is some emergency, something, and we can do it for 1 year, but for maybe 2,500 dollar or maybe maximum 5,000. So that is a little bit similar, but it is everywhere, like all over the Canada. I have seen like I have never seen anybody doing like gold as a security, and even the mutual fund or anything which is not in the fixed term, we cannot, because the value keep on changing, right, for the mutual fund.
Yeah, right.
Yeah, the market fluctuates, so how can it be guaranteed that they are not gonna like,
So that's the reason. That's the reason what some banks does is that they take a margin of 50%, and also while calculating the value of the mutual fund, they look at last 3 months or 6 months, what is the lowest price, what is the lower band it went, and
uh-huh.
they take that value as the value of the security, and then on that they give 50% of the loan amount.
Okay. No, good to know, like, how the India works. It's like, but it's totally different than what we do, but it's
Yeah,
nice,
right.
right? Because
And
maybe,
what you said for gold loan is pretty much right. Okay, only in India people buy gold like
yeah.
so crazy. So so that's true.
Yeah.
And then right. Now, so any questions overall? So if nothing, if not right, then we go to the new domain that is called payments domain. So we'll talk about different payments, terminologies in payments, and then maybe we'll cover touch upon Swift also. Okay, so payments domain is something uh, it's altogether a different training. So whatever the topics we discuss, right? So all these are very wide areas where each one can become a separate full-time training, correct? One big training kind of things, right? So we'll talk about payment system. So we'll touch upon the major aspects of the payment systems, and how the world is moving in the payment system domain. Okay, so just to understand, right, this is a book, there is a book called Bank 3.0. So Brett King, he, he wrote books on how the new generation bank should look like. So Bank 1.0, 2.0. His recent book is Bank 3.0. So there he mentioned a quote saying that bank is no longer somewhere you go. Banking is something you do today, you do at home, or you do through your mobile, you do through your browser. So in olden days, if you see, banking is something like, if I say that I have some work I have some work in the bank, or if I say that I have to do some banking work, that means that I physically go to the bank and wait for my token, and do my transaction and come back to home. That was something used to happen in brick and mortar. is of the banking. Now, if I say that I have some banking work, that means that I just log in my laptop or I just log into my mobile and I do my transaction, correct? Or I just call the customer care executive and I do it. So that is the reason now the definition of the banking is completely changed. So this effectively something what you do is banking, not where you established your branch. There are some banks where there are no branches. There are no branches, in the cities or anywhere. They just do, the banking through online mechanism. Like I think few banks are there where people can operate through Facebook only. So this also effectively means that technology is playing a key role in the whole banking environment. The people who are having technology background or who enable the technology related aspects for the banking domain are in high demand and continue to be in high demand in the market. So when you look at that angle, even payments is a good area where you can see that the customers are using the banking channels, especially the online channels to do the payments. So, okay, before we get into the deep dive of the payments, let us understand what is a payments and settlement system. So when you look at any system,
Hello, sorry.
Yeah, please.
Hi, no, sorry to interrupt. I'll be leaving the meeting now and see you tomorrow. Yeah.
Okay, fine then. Take care.
Thank you. Yeah, thank you.
Okay, so whenever you look at a system includes everything that matters. Say, for example, if I say railway system, so that includes the railway employees, the infrastructure, the customers, and the ticketing system, or the software that manages the trains schedules. Okay, so all these things, everything together, we call it as the railway system. So similarly, when we call it as payments and settlement system, which is a PSS, so this means that so this is an end-to-end mechanism that facilitates the transfer of value from a payer to a beneficiary, by which the payer discharges the payment obligations to the beneficiary. What is payments effectively? So the payer is the one who makes the payment, and beneficiary is the one who receives the payment, or payee, beneficiary, payee, both are same. Okay, so payer is the one who makes the payment and beneficiary is the one who receives the payment. So payment settlement system starts when the payer initiates the payment and it ends once the payment gets credited to the beneficiary. That means that the payer's liability to make the payment is discharged completely. Till that time, the whatever the activities that take place, that entire thing we can call it as the payments and settlement system. So this includes the bank servers, banks, or some central bank. If it is interbank transfer, then some central bank server is included. So all are sending final confirmation messages. So all these things are included as part of the payments and settlement system. So it consists of payment instruments, rules and regulations, procedures, and clearing, transparency, final settlement. It also allows a two-way flow of payments. That effectively means that I can make payment to say Nancy account and Nancy can make payment to me. So this is what we call it as the two-way payments. There are some exemptions to, like suppose you can transfer funds from India to Nepal through NEFT service, but the same NEFT service is not applicable in Nepal to make the payment to India. So that is an example of one-way payment that happens. But otherwise, if you look at broadly, payments and settlement system facilitates two-way flow of the payments. So like vendor to customer to vendor, vendor to customer, or one business to another business to the other business. So in that way, you can see the two-way flow of the payments happens. So what are the things the payment systems use? Okay, who are the users of the payment systems? It could be individuals, banks, companies, governments, uh, any kind of financial institutions. So how the world of payments looks like. So you can see here, it's a broader picture that talks about who are the people using this payment systems. So this is individuals. They use it for making the bill payments, merchant payments, fund transfers, transferring funds from one account to another account, remittances, transferring funds abroad, and digital money like Amazon wallet, digital money. Okay, our cards, it could be debit cards, credit cards. Okay, and then non-individuals like companies, okay, or small and medium enterprises. So one is payables, says they do salary payments, they do vendor payments. So these are all the things, and collections. So they need to collect the funds from their customers. And liquidity management. Sometimes there could be a gap in receiving the funds and paying the funds. So in that case, so some short-term loans are required. So those kind of things, those kind of liquidity management. Liquidity means availability of the cash. Sometimes whenever there is no availability of the cash, how it is managed by taking some small loans or by taking some security and taking the loans. So those things, liquidity management. And mandate management like ECS, debit or credit. So managing that kind of mandates. So these are the usages of the payment system. And then you can see the channels and connectivity. You have online channels and offline channels. Offline channels are like branch or ATM kiosks. Okay, so you have these channels, and these channels connect to the users of the payment to some intermediaries like payment gateways, or payment service providers, or money transfer organizations, banks, okay, mobile money. So all these intermediaries, and through intermediaries, this gets connected to different interfaces. And through these interfaces, it goes to the respective centralized authority where the payment gets processed, and finally the settlement message goes to the initiator of the payment. This is another way of looking at the payment system. Okay, so these payments can be classified into multiple ways. One is based on the location. If it is within a bank, say if I'm a TD bank customer, and then I'm transferring funds to another customer of the TD bank, then it is a internal bank transfer. So which is called as book transfer. And then the transfer can happen within the city. We call it as the local transfer. Within the country is called as domestic transfer. And outside the country is called as the cross-border payments. So in case of cross-border payments, you can also find foreign exchange for as the currency. You can find some foreign currency is used for making the cross-border payments. And the next one is classification based on the payment initiation, push payments and pull payments. Push payment is the payment methodology where the money is pushed from the sender to the receiver. Say if I am transferring funds from my account to your account, so I am pushing the money from my account to your account. So it's a push transfer. Or if an employer is paying salaries to its employees, so the employer is pushing funds from his account and then it is getting credited to the employees' accounts. So this is a push transfer. So pull transfer is something where the money is pushed by the receiver of the payment. Say, for example, if somebody needs to make the EMI payment, they are given a mandate that if every month from their account, so and so amount of EMI can be collected if they give the mandate. Then the receiver of the payment, which is like a bank, right? So they request the borrower's bank to debit the borrower's bank account and make the payment. So that is an example of the pull transfer. Or even instead of paying every month our electricity bill, we may give a mandate to the bank saying that okay, every month you debit my account and pay the electricity bill whenever the electricity department asks for it. So that's also an example of a pull payment. So examples, say push payment. You can see that the employee salary payment or transfer of the funds from one account to another account. So pull payment, you can see the example of SEPA direct debit or a lending institution collecting the loan installment from the borrower. And the next type of classification is based on the transaction value. So all the transactions are divided into generally two types of transactions. One is high value payments and the second one is low value payments. So in case of high value payments, so there is always generally this high value or low value is dependent on the some threshold value. So if it is in India, 2 lakh rupees is the threshold value. If it is more than 2 lakh rupees, we call it as the, if it is 2 lakh and above, okay, I will call, okay, then we call it as the high value. If it is in US, then if it is more than $10,000, then we call it as the high value transaction. So if you look at high value transactions, these are generally used by the corporates. And so low value is something like, below 2 lakh rupees or below $10,000. So these are generally used by the individuals for making retail payments. Say, for example, if I'm if I bought some sabji and then if I'm making the payment, then hardly the payment could be 1,000 or 2,000 rupees. So which is a low value payment. And classification based on the customer types. So one is intra-bank payments, which is within the bank payments happens. So that was not mentioned here. Okay. And then the next one is interbank payments, where the transaction happens between one bank customer to another bank customer. So that is interbank payments. And okay. Oh, okay. This is a different classification. Sorry. So interbank payments is something, the payment happens between one bank to another bank. So if HDFC Bank wants to make the payment to ICICI Bank, then we call that as interbank payment. And if HDFC Bank customer is making payment to say ICICI Bank customer, the transaction is happening between customer to customer. So then we call it as the customer payments. And similarly, if a customer is making payment to bank, say for example, I have to transfer say 10,000 rupees to ICICI Bank for my as a loan processing fee. So in this case, this is also called as the interbank payment only because the payment is going to the bank. And then classification based on the currencies, local currency payments and foreign currency payments. Okay. And processing mechanism, real-time payments and batch payments. Real-time payments are something where each transaction is settled on individual basis. So whereas in case of batch payments, the payment, all the payments will wait for a particular cutoff time, and once that cutoff time over, after that all the payments together gets initiated, and the transaction happens as the batch mode. Only the net amount gets settled between the banks. Say for example, if ICICI Bank, okay, so maybe example is our NEFT, right? So NEFT, if you see, they have a time slot of every half an hour, the one batch gets processed. Say 9 o'clock, okay, one batch gets processed. If I give you a payment instruction at 9:05, it won't get executed immediately. It will wait till the next slot, which is 9:30. So at 9:30, say my bank is Citibank. So Citibank consolidates all the payment requests that has come. So they consolidate and find out, okay, fine. There are 2,000 payment requests came and the total amount is 1,000 crores. So then they send this request to the central bank server. Which is NPCA server, National Payment Council of India. So the NPCA server. So for NPCA server, it sends the entire 2,000 requests that has come, and it also says that okay, the value is say 2,000 crores. And then after that, the NPCA will find out, which bank needs to receive what amount. Okay, and for what customers. So and then so it will effectively takes care of say this 2,000 crores. Okay, say HDFC Bank has to receive 100 crores. ICICI Bank needs to receive 500 crores. Like that, the bank the NPCA server finds out, and then it makes the entire transaction amount as one single batch amount instead of making 2,000 transactions effectively. Entire thing got combined, and only say maybe 10-20 transactions within 10-20 transactions, entire 2,000 crores amount gets settled, and after that the bank will make the payment to respective beneficiaries. And the next one is classification based on the settlement types. The one is gross settlement type, and the next one is net settlement type. So we just discussed. Okay, gross is each transaction is settled individually, whereas in case of net settlement, a group of transactions are combined together, and only the net amount gets settled. And then classification based on the messages. Okay, paper-based payments, which is like our checks and demand drafts are example of the paper-based payments. And the next one is electronic payments. So this is like interbanking payments, card payments, where there is no involvement of the paper, and the transaction happens through the electronic message. Those are called as electronic payments. So you can see some example of how the payments are segregated. So payments, you can see paper based, which is checks, drafts, pay orders, all these things. And you can see electronic payments like based on the instrument. So are based on the settlement type, settlement amount, payment direction, credit or debit. Okay, clearing type. And similarly for the value, high value or low value. Any questions on the payment types or payment system before we go to the next topic?
So just like, just a general question that in India, like, can we transfer, like, say somebody wants to transfer money from SBI to ICICI, can they transfer it, or is it going to be a wire transfer or is it easily transferred like between the banks?
Yeah, okay. So what happens is that if somebody is transferring from SBI to ICICI, so from all these banks are connected through a central server called NPCI server.
Okay.
Okay. So when somebody makes the transfer, then effectively the instruction goes from say SBI to NPCI server, and from NPCI server the instruction goes to SBI, and the amount gets settled between these two banks through the RBI accounts they maintain.
Okay, so it is like a wire, right? Like, I mean, like, it's not immediate. Like, if I want to send money, it doesn't go like I click the button and the money's there.
It's a wire transfer, and within the wire transfer we have two types. One is real-time payment, and the other one is batch payment. So if you choose the mechanism as RTGS, real-time gross settlement, then the payment goes immediately. So the settlement happens real time, but the criteria is that the minimum amount should be 2 lakh rupees. And if you choose, NEFT payment, then it will wait for the batch to trigger. Say every half an hour there is a batch, so through that it gets triggered and the payment goes.
Okay. Okay.
Okay, so there are three key elements in payment and settlement systems. One is the message. So the message can be through paper message like check or demand draft. When you see any check or any demand draft, you see the message that pay to so and so person. Okay, the so and so amount. correct? On so and so date, effectively, right? So you can see all this information, and then you can also see the amount in words as well as numbers form, and whoever is giving the instruction, they will sign on that particular instrument, correct? So if it is a check, so then effectively, whoever is issuing the check, so they will sign it. So that means that they are giving a confirmation that this payment instruction can be done, bank needs to execute it. And if it is a demand draft, here what, so the demand draft is issued by the bank. So effectively, so whoever is the bank authorized person has to sign on the demand draft, then only it is valid. One time when I issue a demand draft, we authorized in the system. So my clerk has printed it, and then he forgot to collect my signature and stamp. And then he went and given to the customer. So the customer also didn't see that there is no signature from the bank. So he went and presented in some bank, and the bank has returned to the customer saying that there is no signature or stamp on the demand draft. So please get it done. Then only we can take this forward. So that is the way. So the signature gives the confirmation that the person whoever is issuing it, so has authenticated this. So if you look at electronic messages, the authentications happens through electronic way. It could be through the user ID and password. And if it wherever two-factor authentication is there, one OTP will also come. So the OTP also need to be authenticated. Then the transaction gets executed. So even if you look at, so this effectively means that the procedure is same, whether it's an online payment or a check-based payment. The procedure methodology is same, the message is same, only the way how you execute is different. Is this clear?
Yes.
So in case of electronic messages, you see that RTGS or EFT or are the ACH transfers, where is the batch payments, automated clearing house. Okay. And then the next important item is clearing. Okay, so where once all the messages come to the centralized server, so how does it process the clearing? Clearing means identifying who has to pay, whom, and how much amount. Say, if thousands people have requested for the payment for transfer of the funds, and it from say HDFC Bank, 1,000 customers has requested for transfer of the funds, and then say ICICI Bank, 5,000 customers have requested, say, SBI, 10,000 customers have requested. So all these requests went to the central server, NPCA server. Okay, then the NPCA server should consolidate all these requests and come up with some net settlement file, which talks about which bank has to receive what amount and what are the customers it has to credit the funds. So that is what the process is the process of clearing. In clearing, the system or the persons who are handling this activity determines who has to pay what amount to whom. And then they come up with a consolidated sheet. So that's what clearing is. So if it is a real-time payment, and individual settlement, then in that case, what happens is that once the transaction comes, then immediately the same debit or credit will happen. If it is a batch payment, then entire set of transactions would come from different banks, and then finally the centralized server determines the who has to get credited for what amount. And then finally the settlement. Settlement is the process where the funds gets settled to the beneficiary of the payment instruction. So, and the settlement is unconditional. So that means that once a payment is done, so till you press enter button, okay, so you want to transfer funds, so and so funds, okay, to so and so person. So till you press enter button, you put all the information, which is the message there, and then after that, till you press submit button, that is in your hands. The funds didn't go. Once you click on submit button, then effectively means that means that the clearing will happen and then final settlement happens. And and you don't have any right to ask back the customers that, hey, I mean, instead of transferring 50,000, I transferred 5 lakh rupees to your account. Can you please refund the difference of 4.5 lakh? You can raise the request, you can raise a dispute, but it's up to the receiver to return the money to you. Maybe you can go to the court and fight, but effectively, if you see this, so the settlement is always unconditional and irrevocable. So once the payment instruction is done and settled to the counterparty, then it is final and it is irrevocable, non-cancelable. Okay, so what are the three key elements in the payment message? So there are three. One is the message, second one is clearing, and the third one is settlement. Okay, so next we will see how payments are made across the world. Okay, so we'll go to the next topic where I can show you. Okay, so if you see here, so the entire payments are divided into two types, right? One is paper-based payments and the second one is electronic payments. So if you see the paper-based payments, then you can see that, you can find some MICR check. MICR check is called as magnetic ink character recognition. So through this MICR check, people will give the message. Okay, so this is a standard form of the check where you can see how the payment happens. Just a process flow, maybe. Okay. And then the other way of payment is the RTGS payment, where the real-time instruction goes. I think in Canada also RTGS is there, no?
I don't know if it is back, in the back end, because when we do the wire, it's just from the branch, the tellers do the wire, and I don't know what happened after that. Like, we don't know. So maybe
Oh.
there is, but we don't have like a very detailed understanding of the the payment transfer. We only know the e-transfer where people do e-transfer, or the automatic transfer if they are making a payment for the loan or anything from other bank, and small information. That's what we have at the branch level, but maybe at the back end, maybe the other departments know much, but I don't have too much knowledge about this.
Okay, fine then, fine. Okay. Okay, yeah. By the way, I have one slide, that gives a comparison between payment systems across the globe. Say, for example, Canada, right? So it is LVTS, Large Value Transfer System, which is an RTGS system. So this is a immediate transfer system. Okay, the minimum amount of transfer could be something like 10,000 Canadian dollars or something. If it is that much amount or more than that, okay, if it is minimum of that 10,000 Canadian dollars, then one can use this large value transfer system. So in this scenario, the transfer happens immediately. And the next one is ACSS system, which is automated clearing settlement system. So this is the batch settlement system. So the equivalent one is in India, it is NEFT system. Okay, and the third one is RTR system. That is real-time rail. Okay, this is something Canada is coming up with. So this is going to be launched in this year, in this December or something. So TCS has got this contract to build the entire infrastructure and make this project live. It could be like as big as like 1,000 employees will work for next 2 years or 3 years to make this entire payment system live and operational, and what are the required additional features are added to the payment system. So these
I
are the
mean,
three.
like, yeah, when looking at like, all this, I feel like India is much better, like, in the banking, because here, like in Canada, like we cannot do a transfer between two banks. It's not like a real time, like where you said like the money goes right away. Like if I have to transfer from TD to RBC, it's a wire, right? They're gonna charge $25 and it can take anywhere from 24 to 48 hours.
Okay, okay. So that means that what they are doing is this is ACSS transfer. The backend, the transfer that is happening is ACSS, Automated Clearing Settlement System. Okay.
Okay. But like for the e-transfer, like I can transfer it to anyone, right? Around the Canada, but it will be like there is a limitation, maybe $3,000 per day, or maybe maximum $10,000 in a week, or 20,000 in a whole month, right? So there is a limitation how much we can do while the email transfer.
Okay. Okay. And how about large transfers? Say, for example, you need to make a payment to your builder, say $200,000. Then what will you do?
We'll just make like, we'll write a draft or something like that, or maybe do a wire. But if it is like you're saying within the bank, right? If he has the same, so
No,
we
no,
can do a
outside the
transfer.
outside
Oh,
the bank. From
outside.
TD bank, you are making the payment to some other bank.
So then it is very easy to take a bank draft, like and then just take it and then deposit, like, give it to that person, to the builder. Usually everything is in a written mode, right? Or for the transfer, it is not allowed to, like, there is a limitation. So they cannot do a $200,000 transfer from one person from TD to the other one. It would be wire, but it takes time then.
Is it okay? 1 second. I think it's no, maybe could be LVTS.
I think like it can be done, but they're gonna charge for that.
Yeah, yeah,
Recently,
the
I
charge
had
is
to
going to
do
be high.
this. Like,
You are
yeah,
right.
I had to get my basement finished. Like, I had to do for that quite a large amount. We can do this. Like, in fact, I did this week.
Oh,
It can be done, but then like they're gonna charge you like I think around $100.
oh,
Hmm.
And you need to go to the branch and then get a permission for that I'll be transferring so much amount, and it can be done immediately within 5 to 10 minutes. But there it's better to meet someone in the bank or the manager or anybody there and get an approval, and then it can be done. Like it in fact it you can done you can it can be done to another bank also.
oh,
But
is
it
it?
should be, yeah, but it should be from the checking account. From
Okay.
your checking, you'll have to move the fund to your checking account and then you can transfer it. But they're going to charge you for that.
That is wire then, right?
Yeah,
But maybe
yeah, it is
it is.
wire transfer. Yeah.
Yeah.
Yeah, right. So, okay, yeah. So this large value transfer system, right? So now it is, it was mentioned that it is replaced by, it was links in 2021. Last year, it was replaced with links. So that the
Oh,
payment system that, okay, so yeah, uh, right. You all are right. Okay, so I mean, it's, they're going to charge it. It's not free. Yeah, effectively, right. Right. So in India, what was happened is that even in India also banks were charging a lot, probably not a lot as compared to Canada. Maybe 100 rupees, 200 rupees per transaction they used to charge. But now what the central bank has done is that so they started giving free service to all the banks. The central service server is there, right? So the server stopped charging the customers for using this service, and they also, and the central bank also told that so we are giving you for free. So if possible, you also offer to the customers for free of cost. So that is the way this effectively Modi driving, right, make in India, and digital payments, correct. So that is the way now there are no charges. Almost all the banks are not charging any amount as a transaction fee for the payments. Even if they charge, the maximum amount they are charging is like 25 rupees.
wow, that's amazing, I would say.
Yeah, right. Yeah. And one more thing is that India has adopted this recently, right? Say, for example, in the last 10 years, right? So that is the reason they got the opportunity to use the best of the world technologies and start using it. Okay. So whereas if you look at and if you look at Canada, so Canada has adopted these kind of practices much before. So 1990s, 19, so those kind of period, right? So that is the reason. So now it's the time for Canada, US to upgrade their infrastructure, and then again they will become the best of the best technologies, and then again, then effectively, other countries will follow. It's like a circle.
Yeah.
So in similarly in USA, so the real-time transfers are called as Fedwire. I'll remove this. Fedwire, and batch transfers are called as ACH, Automated Clearinghouse, or NSS, which stands for National Settlement System. And so there is one more thing called RTFS is there, real-time fund transfer, real-time transfers. So that is CHIPS, Clearinghouse Interbank Payment System. In India, that is called as IMPS, Immediate Payment System. So for small payments, real time, if customers want, they can use this real time, payment system or faster payment system. And if it is a large amount, where more secure way of transferring the funds is required, there people use the RTGS facility.
So Ramesh, is there like an email transfer in India?
Email transfer.
Where I can email you the money, you will
The
get the
e-transfer.
email and you can yeah, e-transfer.
E-transfer, okay.
I
How does
mean
it work?
like what I will do is I'll go in my bank account and then I will add you as a recipient. I can send you via an email or I can send you via the text message on your phone, right? I need your phone number or your email number. And then, sorry, the email address. And then I'm going to add you, I'm going to send you, and there'll be a security question there which you have to answer before. And then you get an email. You're going to click on that and it will ask you where do you have your account, like there'll be all the banks listed, SBI, ICI. You're going to click on that and it's going to take you to your online banking for that bank, and then you're going to accept that money. You're going to write the answer that I gave you, and that is how it is. And here, like, a lot of people have their company account, so it's like an automatic deposit. So if somebody sends, like, a customer sends them the money, it will automatically deposit in their account. So is there something like that?
No. Email mechanism is not there.
Oh,
The other mechanism of adding the beneficiary through the account and then transferring the funds. So that kind of facility is there.
okay.
Good one. Email transfer is a good one actually.
Oh yeah,
Nice.
this is like very common here. Like, even if somebody's buying anything for $10, $5, you do. I mean, like, there is a fees in some of the account, but if you have a good package, like a banking package, then you don't have to pay anything. And it's a very common in US and like a Zelle or Venmo, yeah, something like that in Canada and US.
Okay, nice then. And even